Most people watching this right now think 2026 is going to be the year AI finally pays off for their portfolio. You've spent the last 3 years watching a handful of tech giants carry the entire world economy on their backs, and you've been conditioned to believe that buying the dip is a law of physics. It's not. In fact, for the average retail investor, 2026 is going to be a total bloodbath. But here's the kicker. The market isn't going to fail because the economy collapses. It's going to fail because the obvious winners are about to become the biggest traps in history. If you're still holding the same magnificent stocks that made you rich in 2024, you aren't investing anymore. You're just standing in line to be the exit liquidity for the world's biggest institutions. Today, I'm breaking down the 3 invisible shifts happening right now as we stand on the doorstep of 2026 that will wipe out 90% of retail portfolios. For the last few years, we've lived in a 2-tiered market. You had the AI leaders growing earnings at astronomical rates, and you had the everything else struggling to stay flat. You were rewarded for being concentrated, but as we enter 2026, we are hitting the Great Convergence. The data shows that the massive earnings gap between big tech and the rest of the S&P 500 is closing. While tech growth is normalizing, the old economy, industrials, energy, and healthcare is finally waking up. Most investors will fail because they are performance chasers. They'll keep pouring money into 2024's winners at 40 times earnings, while the institutional smart money is quietly moving into the boring companies that actually trade at a fair price. By the time the retail crowd realizes the leadership has shifted, the tech bubble won't pop. It will just leak for 18 straight months. That slow bleed is exactly how wealth is destroyed. Now, let's talk about the Fed. Everyone has been obsessed with rate cuts. The narrative is simple. Rates go down, stocks go up. But here is what they aren't telling you. We are entering a period of fiscal dominance. The government is spending so much money that the Federal Reserve has essentially lost its superpowers. As we head through 2026, neither side of the political aisle wants to stop the spending. This means inflation isn't going back to 2%. It's becoming a zombie. It stays alive, lurking around 3.5% no matter what the Fed does. If you are positioned for a 2010-style zero interest rate world, you are going to be crushed. In 2026, the cost of capital will stay high. This kills companies that rely on cheap debt to survive, the so-called zombie firms. Most investors have these hiding in their small-cap ETFs without even knowing it. When the 2026 Refinancing Wall hits and these companies have to renew their loans at 8 or 9%, they won't just dip, they'll go to zero. This third trap is psychological, and it's the most dangerous of them all. By 2026, every brokerage app on your phone has been fully gamified. We've seen the rise of 24-hour trading, zero-day options, and now the explosion of prediction markets. You can now bet on anything from election results to the weather directly inside your portfolio. This has destroyed the time horizon of the average investor. Investing is supposed to be the act of owning a piece of a productive business for a decade, but the 2026 market is being designed to make you trade every 10 minutes. The failure in 2026 won't be from a lack of information, it will be from